In this video, trader is going to answer the question, can I take advantage of a widening spread? Stay tuned. Hey traders, a warm welcome to you. All right, so very specific question here from our viewer, subscriber, DJKloop, good name. He said, hey, I've noticed with certain pairs, that the spread increases dramatically as much as 500 to 100 pips or more. Is there a strategy to take advantage of this widening, i.e. have particular orders pre-spread widening? Great question. Okay, so this happens generally, guys, spreads will widen either before market data. Sometimes some companies will widen the spread before market data, i.e. economic data, non-farm payrolls, interest rates, announcements. During it, because they're just passing on the spread that's from the interbank if we're talking about forex, or the futures market if we're talking about NASDAQ or Dow or FTSE. Because when things are going crazy, there's lots of algo activity, liquidity is thin on the order book and the spread can be quite wide. And if you're talking about a broker, a CFD broker, a spread betting broker, a spot forex broker, they will usually, not always, pass that spread on to you. And the other time is sometimes in the evening session. So after hours, technically, you might find that the spread widens out. And again, it's because of lack of liquidity and a wider spread in the underlying. So if you're trading through a broker like a CFD broker, a spread bet broker, or a spot forex broker, you might see this, and we're going to use pips or points as interchangeable, guys. So you might, under normal circumstances, have a 1 point or 1 pip spread. Pips obviously is forex, points, that's just the way we tend to use it if we're talking about currency, we're talking about commodities or indices, but same kind of thing. 50 to 60 would be a widening. So we've now got a 10-point spread, a 10 pip spread. So if you buy at this point in time, you're paying 55. If you bought at this point in time, let's say it's 1 a.m. in the morning, you're paying 60. And the market, let's say the market hasn't moved. Let's say there's no movement in the market in the chart. Same the other side. If you sell, the best price you can sell at is 50. The best price you can sell at is 54. So you don't really have any advantage. In fact, it's just a disadvantage to you when the spread widens if you're a price taker. So you are a price taker if you're trading with a broker, because the broker will only allow you to take the price that they offer. Yes, you can use a limit order, but that will only get triggered if the offer, if it's a buy or the ask, comes down to your level. So let's say you put a buy limit, let's say you do a buy limit, let's say 1 at 1 unit, whatever that may be, at 60. You will only get filled then if the price comes down to 60. So it's a 60, now you'll get filled. Now, if you went and put a sell limit, so you're thinking, right, how? Well, I can take advantage of this. I can put a sell limit at 60 and get filled at 60 and take advantage of the widening spread. You'd only get filled on that is a 6, honestly, guys. You'd only get filled on that if the bid went to 60. So the bid would have to come up and that would have to be 60 to whatever that may be. So you've got no advantage by using a limit order when you're a price taker. So the answer, if you are trading with a broker, is no. It's just a disadvantage to you, because actually you can end up being stopped out. You might not even get filled on your limit. You might, if you're in there, if you wanted to buy at 55, say, let's say the limit at 55, to buy, to cover your positions, take your profits, bank your winnings. If it was 50, 60, you wouldn't get filled. If it was 54, 55, you get filled on that and you'd be able to close the trade. So widening the spread is never any good for you if you're a price taker. The only other time we've got is if we are on the other side of the trade. So if you have direct access to the market, i.e. you're trading directly on the New York Stock Exchange, you're trading the NASDAQ, you're trading NYMEX, any of the futures, you're going directly to the exchange, and that would be a different broker. The broker then would give you access to the exchange and you'd pay a commission, and it's something you can choose to do or not. The barrier to entry is very, very similar. Then it becomes a different story. As the spread widens, you can become someone who is adding liquidity. So if you see the spread widen to 50 to 60, you can come in with your order and come in and put a bid in then at 51, right? So if you get filled, you are filled at 51, then you are taking advantage of that widening spread. Or you could sit on 50 if you wanted as well, of course. And then maybe, in theoretically speaking, this is easier said than done, you could come in and offer 59. So you could sit there and be a market maker, adding liquidity, take advantage of the widening spread by narrowing it slightly, and then you're sitting there at 51 to 59. If you've got filled on both of those, you make 8 pips. right? So this is only applicable if you are going direct to the exchange. You can put your orders into the order book. Now this is a common tactic, guys. I know a lot of people who used to do this. It's not so lucrative anymore, and the spread's widening for a reason. Generally the spread's widening because there's not much liquidity, or if you are going to get hit, the market is just going to move up anyway. You get hit on 59, it jumps straight up to 70, so you're kind of taking the risk that way. So another thing you can do as well is, going back to the question of taking advantage of a widening spread. If you want to take advantage of this kind of stuff, if you're direct to the market, there's nothing stopping you, let's say, putting in speculative bids at say 5 and 98, for example, and you could have them there so that if the spread widened, if someone came down and swept the market, of course you're vulnerable potentially to the market just moving against you and filling you. But this is a strategy that some people employ, that when maybe there's news or data and the spread's widening, it's flicking about a bit, just putting some staggered high bids and offers away from the market. Someone might just put a market order in, it might just tag you, the spread might go wide, but the fact that someone's buying and buying the offer, buying the offer, buying the offer, you're sitting on the offer, you might get filled on that 98, and then it comes back to kind of 60 or 40 or whatever, and you can get the deal, take the deal off from there. But that's a different strategy. That's something you've got to be very careful of and very mindful of, and kind of do your own research to get involved in that. But for the majority of people who are price takers, which we are if we trade through a broker, the widening spread is no good because you're just not going to get filled on having speculative orders in, and in fact it's just going to do you no favors whatsoever, and you could get stopped out and all this kind of stuff. So widening spread, generally no good. That's why I always look for a broker, guys, that's got a good tight spread, and some brokers will offer fixed spreads, some offer kind of variable spreads, and it's up to you to decide which one to choose. You want to check out our channel sponsor, guys, our broker that are sponsoring our channel. There's a link to them in the description below. Go and check them out, and you can see different account types and all that other good stuff. So can I take advantage of a widening spread? Only if you are going direct to market is the kind of short answer to that. Appreciate the questions though. Take care. Bye bye.